If you're anything like me, investing in the stock market might seem like a scary concept. But it does not have to be. In fact, it's far easier than you might expect. Today we are going to take a dive into the fascinating world of the stock market, from its historical roots to the 1929 market crash, all the way to understanding how and why stock prices fluctuate. The stock market has a rich history dating back centuries. In fact, the first stock market can be traced back to 17th century Amsterdam, where the Dutch East India Company was the first to issue stocks and bonds to the public. This innovation allowed the company to raise massive amounts of operating capital with little extra effort or product, just like companies do today. Now, let's turn our attention to the 1929 market crash. As we all know, this historic event had devastating consequences, triggering the Great Depression and leaving countless investors in financial ruin. One of the major factors that contributed to the crash was the lack of oversight and regulation in the market. Companies were able to make false claims and manipulate stock prices without consequences. This led to a speculative bubble that eventually burst, causing panic selling and widespread losses. Thankfully, the government recognized the need for change and established the SEC, also known as the Securities and Exchange Commission, in 1934 to protect investors and ensure fair and transparent markets. Today, the SEC remains a critical component of the U.S. financial regulatory system, and similar agencies exist in other countries to provide oversight and prevent market manipulation. Now, let's talk about what exactly a stock is. Essentially, it's a financial token that signifies ownership of a company in some proportion. When you own a stock, you own a portion of that company. And as the value of that company increases, so does your stock price. There are also common and preferred stocks, which refer to the voting rights of a shareholder. Common shares have voting rights, and preferred shares don't. When you have voting rights, you can vote on things like board elections and mergers. Preferred shares, on the other hand, get preference when a company pays a dividend and in other financial situations. But why exactly do companies sell stocks? The answer is simple, and it is to raise money. Companies list shares by selling them through an initial public offering or IPO on an exchange. This essentially changes the status of a company from a privately held business to a publicly traded one. Once a company's stocks are listed on an exchange, the public can trade them. To understand how stock prices fluctuate, it's essential to recognize the various factors that can move a stock up or down. The first category of forces that affect stock prices is a company's performance. This includes financial metrics such as revenue growth, earnings per share, and profit margins. Positive financial performance can lead to increased demand for a company's stock and higher stock prices, while poor performance can result in lower demand and lower stock prices. The second category of forces that can impact the stock market are economic indicators. Interest rates, inflation, and gross domestic product, GDP, are examples of economic indicators that can affect the stock market as a whole. For instance, if interest rates rise, borrowing costs increase, which can lead to lower profits for companies and lower stock prices. Market sentiment is another crucial factor that affects stock prices. It refers to the overall feeling or mood of investors and traders towards the stock market or specific stocks. Positive sentiment can lead to higher demand for stocks and higher stock prices, while negative sentiment can lead to lower demand and lower prices. The fourth category of forces that can affect stock prices are news and events. News such as product launches, mergers and acquisitions, and legal or regulatory issues can impact a company's stock price. A positive news announcement can lead to increased demand and higher stock prices, while negative news can lead to decreased demand and lower prices. Technical factors, such as trading volume, price trends, and support and resistance levels, make up the fifth category of forces that can impact stock prices. Technical analysts use these factors to predict future price movements and make investment decisions. It's important to note that while these five categories of forces are significant factors that can affect stock prices, they are not the only ones. Other factors, such as geopolitical events, natural disasters, and changes in government policies, can also have a significant impact on the stock market. Furthermore, the relationship between these forces is not always straightforward, and one force can often influence another. For instance, a company's poor financial performance can lead to negative market sentiment and a drop in its stock price, which can, in turn, impact the broader market sentiment. As a result, investors and traders must consider a wide range of factors when analyzing stock prices and making investment decisions. Ultimately, understanding the forces that drive stock prices is essential to succeed in the stock market. In conclusion, the stock market can seem overwhelming, but with a basic understanding of how it works, it can be a valuable investment tool. The stock market allows companies to raise capital and gives individuals the opportunity to invest in those companies. While the factors that affect stock prices can be complex and varied, investors can make informed decisions by doing their research and diversifying their portfolio. Remember, never put all your eggs in one basket, and may the bull be with you as you navigate the stock market. Thank you for watching.